All right, guys, bang, bang. I have Cathie here with us. This is her second appearance on the podcast. I don't ever admit this usually, but her first conversation with me was my favorite episode ever. And when I told people that she was coming back on, many people were tweeting at me saying that this was their favorite episode as well. So no pressure. We'll see if we can do it again.
All right.
Awesome. Listen, you've been doing this for a long time. This is not your first rodeo, not your first economic crisis. Let's just start with, given the historical context and all the experience you have, like what is going on now and should people be worried or not?
Right. Well, thank you, Pomp, very much for your kind words and for inviting me back. Yes, I have been in the business for more than 40 years. I started when I was in college. And so I've been through 10 crises, if you include recessions. And this appears to me to be like two of them. And the two were shocks, shocks to the system, unexpected, sudden. The first one was when portfolio insurance failed in October of '87 and created Black Monday. That's when the stock market dropped by almost 25% in one day. That didn't happen this time around. And quite simply, those who thought they could get out of the market because they were insured, that insurance failed. And so it caused all kinds of concerns about systemic effects and so forth. Instead, what happened was the people who had bought portfolio insurance were the losers. This was a shock. People were waiting around thinking, okay, is this going to have reverberations beyond this? And as it turned out, it didn't. So forces in motion before that shock continued in motion. The 80s was a great bull market, and that continued. The second time, many people think it's 08, 09. No, it's not. That was a true financial crisis meltdown. This is a shock. It's a healthcare crisis, which has financial ramifications, but it's a shock to the system. And so in 9/11, shock to the system then, we were in the middle of the tech and telecom bust. Everyone was waiting around to see, okay, is this systemic in terms of 9/11, more terrorist attacks and so forth? It wasn't. And forces in motion stayed in motion. The tech and telecom bust continued for another 18 months. This time around, we were in a very strong economy. And in fact, it was much stronger than what people perceive it to have been now. And the reason for that is in both China and the US, the consumer was really strong. And in the US in particular, the consumer also had a large buffer, an 8% saving rate, which has doubled over the last, I'm going to say 10 years. So an 8% saving rate, nice buffer, consumer spending very strong, but businesses were pulling back. And they had been pulling back for 18 months because of the China-US trade conflict and because of inverted yield curves, which businesses were sure were going to trigger a recession. Well, that is not what triggered the recession. And I'm not even sure that this will, in hindsight, be considered a recession. We'll see. I'm seeing numbers. A recession, the official definition is back-to-back quarters of negative GDP. Looks like first quarter will be up. Looks like second quarter will be down big. And the question is, will we be down in the third? Not sure about that. Depends on how fast we get back to work. So I believe that forces in motion before this crisis will continue in motion. We will end up in more of a V-shaped recovery, I think, than most people believe because of the setup. The consumer was strong, had a nice buffer, savings buffer. Businesses had already pulled back. And if the consumer comes back, businesses are going to have to race to catch up to the consumer.
Yeah. And so how do you take some of the data points that we're seeing? So we've got, I think about 16, 17 million Americans who have filed for unemployment in the last 3 weeks, right? On top of the 5.8 million or so at the end of February that were unemployed. So call it, 20 to 22 million is kind of the official number. Obviously there's some undercounting that probably goes on there. Then you see things like, I think there's a Wall Street Journal article that said a third of renters didn't pay rent, right? And I'm probably with you in that you could question the accuracy of some of the surveys and things like that, but it's a bigger number than I think most of us expected. Is that kind of temporary type pain that the consumer or the average citizen experiences, or is there something that potentially you could get economic gain in the third quarter, and then you get the consumer that still suffers a little bit? Like, how do you think through that?
Yeah, well, in terms of the numbers, I heard today on CNBC, the CEO of Related, which has widespread real estate holdings. So he gave numbers through yesterday, and in his complex of the multi-dwelling homes, he said 90% of those people are paying their rent, which was higher than he expected. In commercial real estate, again, this is one company, but has very broad base, 100% are paying rent. And the biggest laggard is retail. The retailers are on paper thin margins, so only a third of his retail tenants are paying rent, whereas I think for the nation, it's more like down to 20%. So there's the weak link right there, right? And a lot of the people who are out of work are from bricks and mortar, more mom and pop, small businesses. So yes, I've been surprised at how much work is taking place digitally. Our business has not skipped a beat, not a beat. And in fact, I think we're so much more productive now in some ways than we are on a day-to-day basis. Maybe I'm speaking for myself, I don't know. So I think we're going to see an accelerated shift into an online work situation, which ultimately could hurt commercial. But in terms of the next half year, I think the Trump administration, the task force in particular, every day reassuring the nation, saying this is going to be temporary, this is going to be, and we're looking for, now most people don't believe Trump when he says, well, this is going to be the sharpest, most vigorous. But they have to take into consideration that could happen, and that if they start doing stupid things like shutting down, they'll be deprived of a big whip. I think that's been very important. So I think it come out faster, including, we had labor shortages before, So I think we're going to come out of this faster than most people expect.
Yeah, and one of the things you're kind of hinting at here is there's a couple of people who have started to say, look, the virus may actually be an accelerant on the way into the economic shock, obviously, right? Hey, there were some issues. We're now seeing some of that accelerated, but it may also be an accelerant in terms of other trends. So things like remote work, a lot of technology-enabled things. It sounds like you're pretty strong in that camp of believing that coming out of this, those trends just now are more likely to occur or happen faster than they already were on pace to do.
Yeah, so I started ARK in 2014, and we've probably had 5 significant risk-off, risk-on periods. And during each of those periods, I would lend perspective to our young analyst team and say, look, I've been through a lot of crises. Innovation gains market share at an accelerated rate in a crisis. Why? Better, cheaper, faster, more productive, more creative, new products and services to solve problems. And I think that's true here. I think this is, we're at what I often call the sweet spot of the S-curve, just entering the steepest part. Even for online retail, I think many people are surprised, given our own habits, to learn that online retail in the United States is still only 15% of total retail sales. Now, I think in all of our lives, it's gone up to the majority of sales, or maybe not majority of non-grocery sales. Even groceries are now coming online in a bigger way, thanks to Whole Foods, Amazon, and so forth. So I think some of the trends in motion that we thought we were just entering the sweet spot of the S-curve for retail, I think this has accelerated it, as it has for online education, which is not at the sweet spot, but is definitely a trend. Telemedicine, when you get Medicare reimbursing telemedicine, you're onto something big. So teledoc there, online education to you. And these stocks have been affected in different ways. Teladoc has held up beautifully. It went out to an all-time high. And we've tended to sell those stocks in favor of a company like 2U, which, because of its low cash buffer and high cash burn, it's in a high investment phase of its life, algorithms out there, these are mindless algorithms. All they do in a crisis is say, okay, two things matter: low cash buffer, high cash burn. And they go out and they kill those stocks. So 2U went from $30 to $11.50 in 2 weeks. That's nuts. That's nuts when it's one of the solutions to the problem, that we're facing out there. So, we were looking around for those sorts of names, which we know are going to be able to access the capital markets if they need it, because it's so clear they're a solution to the problem.
Yeah. Let's talk a little bit about kind of the health crisis first, and then we'll get into the economic and policies and things there.
Sure.
The virus has shut down entire societies, right? I mean, countries, et cetera. What's kind of your take on, is the health crisis warranted in the sense of the response we have on the health side? Are we doing enough, not enough? Kind of how do you think through that?
Yeah. There have been 2 other coronaviruses circulating through our economy on a regular basis. They're annual now. They're part of now our annual flu season. So this coronavirus is different in that it's much more contagious, but much less deadly, right? So, but when you put those 2 together, the much more contagious, it could hit a lot more people. Much less lethal. Well, maybe it would be typical flu-like numbers, which are anywhere from, in the United States, 30,000 to 70,000 a year. Now, it looks like this one's going to kill maybe 60,000. And I guess that's the only number we can really count on, because we don't know how many people really have been infected. 2 people in my sphere, meaning my household and household help, have been infected. So I think, when books are written about this, we'll say, okay, that was an overreaction. And yes, there is a group of people that we must protect when something is that contagious, even if it is less lethal. And in this case, it was those with other lung compromised diseases, as well as maybe people with high blood pressure. We're not sure about that one yet. And a couple of things are happening because of this virus. First of all, we could not have sequenced it in 2 days. China sequenced it in 2 days. It took us 5 months to sequence the SARS virus back in 2003. So that happened very quickly. Now, China probably knew the sequence, my guess is, well before they shared it with us. And if we had had it sooner, we would have understood it better. But now I think the other thing that we're learning, the tests that Abbott and Cepheid, which is owned by Danaher, have put out, and I know Cepheid well because I owned it before Danaher bought it, and really, really good company. They're actually based on old-time PCR technology. It's old technology. But what got them to market as fast as they could get to market were 2 things. First of all, the sequencing of the virus. We understand exactly what it is, and we understand how it's mutating too. That's thanks to companies like Illumina. And then the second is synthetic biology. So if sequencing is the ability to read the DNA of a virus, synthetic biology is the ability to write the DNA of a virus. And that company is Twist. It's one of the most advanced out there. Not many people know it, but it's an amazing company. If they had not done those 2 things, Abbott and Cepheid wouldn't have been able to develop the tests as quickly as they have. So that's good. And I think the other thing that's coming out of this, there are 2 other things from a healthcare point of view. So the SARS epidemic in 2003, it circled the world and then went poof, it disappeared, unlike the other coronaviruses I mentioned to you. And so what happened during SARS, that was a crisis. I mean, SARS was, the lethality of SARS was at least 10%. Ebola was, it was, well above 50%. And MERS was somewhere in between there. So again, this is much less deadly. We don't know how deadly it is because we don't know how many people have gotten it. We'll know after the fact. Back then, SARS, vaccines, like there was so much money pushed into the development of vaccines. It went poof, and the funding for vaccines dried up, and then nobody wanted to be in vaccines. All these big pharma companies sold their vaccine companies because they were money pits, right? Now, again, now that we have new technologies like Moderna and Inovio and Arcturus. Moderna and Arcturus are based on RNA technology, Inovio on DNA technology. RNA, we've never seen it work. If it works, it's going to be amazing. And it'll be a very profitable, it's going to be a winner take most, because these companies have developed libraries of data and are going to be able to at least get the licensing fees, royalties on all of this. So I think vaccine is going to be a good place to be. And the other thing I think that this healthcare crisis has done is it's providing a lot of political cover. What politician is going to say, no, I don't want to pay for testing for this, that, or the other disease, or I don't want to pay for vaccines. We're not going to put that in the budgets. No, testing, which has also been, it's considered historically a commoditized business. And you have two big companies dominating. You have Quest and LabCorp in the old world, and it's mostly commoditized. Even their esoteric tests become commoditized just because they're so big. And now what's happening is you get a company like Invitae or Guardant or Personalis. Some of these you may have heard of. What they are doing, I think this is going to be a winner take most world, like so many in the artificial intelligence world. They are gathering all the data. They have harnessed geneticists throughout the world, these pools of geneticists, and they are beginning to develop tests that are very precise and because they've collected the right kind of data. So I think they're going to have so much more political cover than they have had historically. It's always been an area starved of funding. Because everyone assumed it's commoditized. It's not. We have the convergence of DNA sequencing, artificial intelligence, and then CRISPR gene editing, which is going to not only will we be able to create these tests so that to understand in a very personal way how your DNA is influenced, right? And what is impacted, how your DNA is mutating. They'll be able to figure that out, and then they'll be able to pull therapies off the shelf, or they'll be able to design them with gene editing to actually cure or reprogram your DNA and cure the disease. That's where we're going.
Yeah, it's super exciting to see kind of the healthcare side. And I think that the idea of a vaccine or cure is a health component, but it's also a psychological component. Once people know that's out there, I think that changes the mindset. What is your thoughts about the economic cure, right? So we kind of have a health crisis that's causing an economic crisis or kind of a shock as you described it. There's a lot of economic policies that have been implemented. What's kind of your general view of what's already been done and maybe even what needs to be done in the future?
Right. So my mentor is Art Laffer. I don't know if you're familiar with the Laffer curve, supply side economics, but he advises President Trump informally, regularly. And I know, because I hear during the task force briefings, I hear some of the things that Art Laffer says coming out of President Trump's mouth. In the beginning, Art was very frustrated that they were just throwing money at this, just willy-nilly, and effectively throwing money at the idea that we don't want people to work. And from one point of view, that was correct. We wanted people, if they could, to work from home, of course, but we wanted them to be safe, first and foremost. The programs that were being designed in the early days and were just throw the money at them have been modified so that you're seeing more in the form of loans to small businesses and others that will have to be repaid after a long grace period. So that is good, just to keep the infrastructure in place, to allow the employment to rebound afterwards, instead of, unlike in a recession where you have capital destruction, it takes a long time to work through it and then to come back. So I think that's good. I think it's good that they are sending checks out to those who are living paycheck to paycheck. But I think a more important way to help those people, and would have the same effect, would be to say, and I've heard President Trump mention it, it hasn't been put into any legislation yet, to basically go on a payroll tax holiday, both for the employers and the employees through the end of the year. What would that do? It would encourage businesses who are getting these holidays and employees to get back to work as quickly as possible, to take advantage of the holiday and increase their returns by 6 to 7% on either side. That's huge. That's the tax wedge that Art Laffer talks about all the time. If you get rid of that wedge, you'll bring a lot more activity back much sooner than otherwise would be the case. And I think the other, in terms of the way they're treating larger corporations, I think they're creating inducements to rev back up faster. What they're doing is they're saying, okay, if you take these loans, then you cannot buy back shares or pay dividends for a year past when, and I don't know if the legislation has changed here a bit, but this is how it was being written, a year past the day you repay those loans. Well, what will that cause? Shareholders certainly will want their companies to get back on track much faster so they can pay back the loans to the government and then get back to paying dividends, which for many people are a large chunk of their income, especially retirees, and to repurchase shares, which favors all shareholders. So I think they're doing things, they're gradually getting it right and very sensitive. You hear more and more about, you hear certainly the president and the vice president talking about getting people back to work safely. So you'll have Pence focused on the safety and you'll have Trump focused on getting back to work. And it's a good dynamic and an important dynamic, I think.
Yeah. Are you worried at all? We're in a deflationary environment now. There's a lot of QE going on. Are you worried that we could over-rotate on the inflationary side when we switch back? And are there any impacts that you foresee potentially on the US dollar as kind of a global asset or a reserve asset?
Mm-hmm. Okay, so the first question, and when we can take some of, we can inform the answer to that question partly by what happened after 0809. So I remember when, it was QE everything, I remembered being concerned saying, wow, this is just such an inducement to take a lot of risk and just go out there and go for it. That's not what happened. What happened was people were so traumatized by the near breakdown of our financial and economic system that they were not sure we were going to be able to hold together. And there were all kinds of uncertainties, including what became the election year. We had the European sovereign debt crisis. We had in 2016 oil prices crashing like they have recently, and China seeming to implode. And so every step along the way, there was a reason for people to hold back and not throw everything that they have at risk taking. And in fact, the velocity of money, which is the critical answer here, has been falling, and my guess is falling at an accelerated rate now. And so all of that QE, most of it is still sitting on the balance sheets of central banks. Now, the way I think about that still is that is kindling for the potential fire that you're talking about. But that kindling hasn't been lit for the past 10 years because every step along the way, including the China-US trade conflict and the inverted yield curves, every one of those steps along the way has been a reason to recoil and say, so the velocity of money has continued to come down. Now, we have M2 today growing at a 15% year-over-year rate, which is, I believe, the fastest. I mean, you have to go back a lot of years to see that. I think many people have gotten used to this idea that we can throw anything we want at the system and velocity will fall and offset it. There will become a day, and this could be the beginning, but I don't think it will. I don't think we'll see the ramifications in terms of inflation for, I'm going to say, at least a year and a half, maybe 2 years. Because first, we still do have a little bit of this seizing up and people saying, is my job going to be there? So that's one reason. And business is the same. Is my business going to exist? So again, another reason. If you look, I just listened to the JP Morgan call this morning, and you know, so many businesses have taken down their revolvers completely, you know? So they are just awash in cash. They're awash in cash. And they did the same thing in 08, 09. But again, nothing happened, everybody being scared every step along the way. So the reason we won't have an inflation problem for the next 18 months, 2 years, there are two reasons. One, oil prices have crashed, and oil is a big part of, you know, the input. And there's a good reason secularly for oil to crash. We talk about it all the time. I think oil's going down longer term to $10 or less per barrel. And I've been saying that for a while. That's a personal point of view. And that's because of electric vehicles and autonomous electric vehicles. At the margin, gas-powered cars are going to start losing out, and commodity prices are determined at the margin. That's what a lot of people miss when they say, oh, well, electric vehicles are only 2% of all sales. No, they're a much higher percentage of the growth in the auto industry, right? So the first reason is that major input to so many industries. The second is, typically, if we're going to have a V-shaped recovery, what will happen is productivity will surge. Now, productivity was already starting to surge. So again, this idea of forces in motion continue in motion. I think the accelerated shift into new technologies now is going to cause an acceleration in productivity growth. We're probably going to see productivity growth numbers in the next year that we haven't seen, I'm going to say, since the 60s. So that's another reason. Productivity is a huge force against inflation. Why? Because a company which benefits from productivity can do three things with it. It can increase wages. So if companies have labor shortages, they will increase wages, but not now. Nobody has labor shortage because the unemployment rate's going to go to 15% or whatever, or higher. It can go to lower prices to compete and bring consumers back, and to compete against China, because China is using innovation and deflation to compete. So that's another thing that could happen here, which would reinforce this disinflationary cycle. Or it can go to increase profit margins. And it's probably going to, depending on the industry, going to go to all three. So I don't think we'll see inflation in the near term. I do worry about it now that no one thinks it's possible anymore. I remember starting in the business, it was the late 70s, I was in college, and I remember looking at these CPI numbers that were coming out, and economists didn't believe them because they thought inflation had been licked That when really it had just started because we went off the gold exchange standard in 1971. But no one could believe the numbers we were seeing. And that's because they had been lulled into complacency that the Fed could do anything it wanted. Well, I think that we're back in that situation, but we will not face, and I know where you're going with this, obviously, Bitcoin, we won't face the real ramifications for another couple of years. But, you know, I know we've increased our Bitcoin exposure. We're in the discretionary portfolios at ARK. I think it's the right thing to do from an insurance policy point of view.
Yeah, we're definitely going to get to Bitcoin for sure. Well, one of the things I want to talk about before is let's just talk about innovation in a time of crisis first, and then we can kind of go through a number of either different investments or industries that I know you guys are interested in, and we'll finish up with Bitcoin. But when it comes to innovation, you've said a number of times now that innovation almost like steals market share during these times of crisis, right? And technology has a massive advantage. Maybe elaborate on that a little bit and explain kind of what you mean by that, and if you have any examples of where that's happened before.
Sure. I'll start out by giving you 2 examples from the 08-09 period, since we have that data, and we don't have all the data from this crisis yet. Although I can tell you from the way our stocks are behaving, the market is beginning to understand this. Whereas in 08-09, if you looked at Salesforce.com, you would have thought it was going out of business. So what happened in 08-09? I remember listening to researchers from GE saying, you know, our tech budgets have been shut down effectively. I can't get any of my projects done. I'm using my personal credit card to pay as I go, buy Salesforce.com software as a service, and I'll put that in as an expense. It's not a capital spending item anymore. And that was an aha moment for me, certainly. So if you look back then, most software stocks, companies, which had the enterprise license model, which most of them did at the time, their budgets were cut enormously, or they were hit badly. If you look at, and Salesforce.com was just taken down with all of them, like it was, but because it was a newbie, like it was going out of business. It sold off worse than some of the enterprise license model players. When you look back on what happened there, while tech budgets were down 20 to 30%, Salesforce.com was an answer to a problem. I can't afford these big enterprise license fees, the upfront fees. I can't at the end of 08, I can't renew. I have to move over to Salesforce.com, pay as you go, and other software as a service models. Salesforce.com's worst quarter in that crisis from a revenue growth point of view, remember people thought it was going out of business, was up 20% in the worst crisis since the Great Depression. Retail sales for many, I looked at retail sales numbers going back to 08. The macro sales, they were down 10 to 12% at their worst. Amazon's worst quarter was up 14%. And I think their worst quarter this time around there's not going to be a worse quarter. Their sales aren't going to skip a beat. They're one of the biggest beneficiaries. If you look at Amazon's sales growth over the last 20 years, they've averaged almost 25%. And, you know, if you had told someone back then that was going to happen, well, first of all, no one would believe it. If in our world, what people do even today, because they're so value oriented, they say, okay, this innovator's sales, yeah, they can grow for 25% for the next 2 to 3 years. Then they'll decay to the GDP growth rate. That's not what's happening now. The waves of innovation that we're seeing, and Amazon is the first proof of concept of this idea that we could actually see some of these companies grow at an exponential rate. And all that means is that they will sustain some kind of super growth number like 25% instead of decaying according to the law of large numbers, right? I think that I think our portfolios are teeming with that kind of stock. And what we tend to do during a period like this is we will consolidate towards either our highest conviction names or the stocks, like I mentioned to you, that are so misunderstood in terms of there being a solution to the problem. So I can rattle through if you'd like me to rattle through by sector or industry. Now, the obvious beneficiaries, which have done very well, Amazon just went out to a new high today, an all-time high. So Amazon and Netflix, I would put Teladoc and Zoom into this category. Zoom, despite its problems with privacy and exposure to China in terms of having its workers there, they've been obvious beneficiaries, and people have flocked to, investors have flocked to them. So when that is happening in our portfolios, particularly in our flagship portfolio, we will be more opportunistic and use those as cash sources in order to deploy towards the much less well-recognized beneficiaries. So while Zoom is very well recognized, you'll have companies like Zscaler in the security space and PagerDuty in the instant management space. You'll have, I have some noted, Pure Storage in solid state, in the storage space, the new wave of storage though. You'll have, well, you'll have Workday. Workday is well understood, but I think it's at a point of accelerated shift as well, because it's moving, it's infiltrated through HR departments, and now it's moving into financial, and it's really getting at the Oracles and the SAPs of the world. So again, what this is saying is the old guard is going to lose share at an accelerated rate. Beware. Those are the companies that occupy the highest positions in the index funds out there, because they're the largest caps. It's these newbies that are nipping at their heels that have, you know, the opportunity to be 10 baggers, as we say, because they're not well recognized. In the media.
Cathie, part of this, sorry to interrupt, but I guess part of this too is it's not just the names, right? I think one of the things that you're highlighting here is it's also the strategy of, you know, take a Zoom, everyone sees that it's working, everyone's piling in. It's very easy for there to be a bubble like mania in a single name because it's the obvious choice. What it sounds like you guys are doing is you actually start, as that rides and people recognize it, you actually start trimming a little of the position, take that cash, and then you go look for what's the next wave that everyone's going to realize, oh, that's a beneficiary. But if you can find those before it, you're going to benefit obviously from the growth that it'll experience. Right,
and the popularity of Zoom is going to feed these other infrastructure players, because we need the infrastructure to support it, right? So we owned Zoom, and we owned it in a small size though, because the enterprise value to sales ratio is up at, I think at the time, 50 times. I mean, it was crazy. Right? Enterprise value to sales, right? That includes debt and everything. And we just said, okay, we'll put it in because it certainly is disruptive and is taking share from the WebExes and the other more established but kludgy players. It's not really taking share from Teams, which is Microsoft, but they're both growing very rapidly together. But we sold it out when it just took off as everything else was plummeting. And so that is where we will make a valuation call like that, saying, okay, this now everyone recognizes, and it's gone even further north in terms of that valuation. And look at these others that are there to support it, but are being dumped, right? So that's really important.
It's really interesting too, because I think that part of this, of your strategy, it's not rocket science, right? It's basically find the value before others recognize it, have the courage and conviction to invest capital in those businesses. And then as other people realize that that's an obvious winner or beneficiary, whether it's from the virus or some other sector, you benefit. And one of where I think you really kind of went to bat, and there was a lot of people saying there's no way you're right, and all stuff, was Tesla, right? And you guys were early, and I believe even when the price continued to fall, you continued to buy, right? Like the ultimate sign of conviction. And you've kind of been proven right to some degree as we sit today. Maybe talk a little bit about like that specific name and kind of what you guys have seen there.
Well, what's so interesting, okay, so at the beginning of this year, it soared to almost $1,000. Last May, this time last year, it had dropped to 100, and it got into the 170s. And we were buying all the way down. And, you know, I often say I'm the most trolled portfolio manager on Twitter. And I am in that, and because that, not because of me, but because of Elon and that stock and all the shorts that who were supporting it. And we had built a very strong case. It's our highest conviction name still. So, but it soared to 900 plus. We were taking profits. If we hadn't taken profits, it would have been at 20 to 25% of our portfolios, which we absolutely cannot let happen. We can only buy up to 10%. So from a psychological point of view, what I like to do when it goes above 10%, I mean, I like to let it ride, certainly, but at some point, like to take it down, back down to 10%, so that if it drops from there, remember, we can't buy if it's 10% plus. If it does drop from 10%, though, we can buy again. So I usually like to take it down to 10%, and then it drops, and it did. It dropped all the way down to $350 in this crisis. And why? Because the shorts were saying, aha, even though they have $8 billion in cash now, they're saying, oil prices are crashing. No reason to buy an electric vehicle. Crazy talk. Even we've done the total cost of ownership with oil prices at this level. It's still cheaper to own an electric vehicle today. Now on a sticker price basis, maybe it'll take a year or so. But so we were buying all the way down to 350. I can't tell you what the mark was, the last mark. You never catch exactly the bottom. We kept taking it back up to 10%. So that's our style. And now again, I think it's up to 13.5% of our portfolio today because it's had another nice move. Why is this move happening? It's happening because the bears, who are typically auto analysts, are seeing what their traditional auto companies are doing in this period. In order to preserve a 6 or 7% dividend, GM is having to cut spending. And where is it cutting its spending? Electric vehicles. It's cutting everywhere, but electric vehicles. It's going to fall even further behind Tesla in terms of its EV. And we think it's already 2 to 3 to maybe 4 years behind, probably 4 years behind, and we'll be going 5 years behind. I think it's becoming obvious to these auto analysts, finally, how long a lead time Tesla has relative to the other auto manufacturers. And you know, they are in harm's way financially. Ford eliminated its dividend. GM's still keeping its dividend. My guess is it will go too. And that will continue to highlight, you know, Tesla doesn't have a dividend. 100% of its R&D is in electric. It doesn't have to share with internal combustion engine R&D. Which they still have to, they still have to spend that money. That's the 95% plus of their fleets, right? And so we think Tesla, because of this crisis, has gained even more lead time here.
Yeah, and I guess when the oil prices crash like this, the argument that one, Tesla is still cheaper, right? It is kind of one component of it. But it's really interesting to think about Tesla actually gaining market share, even though oil prices are crashing, right? And it has more to do with what the incumbents are not going to do versus what Tesla is doing, right? Tesla sounds like it's just doing what they've been doing the whole time. It's everybody else starts cutting back, and therefore Tesla ends up benefiting from a gain in market share.
Yeah, if you, using the first quarter numbers, so last year, Tesla had 17% of the global EV market, including China, which is the largest market. Now, I think these are just US numbers. They could be global though. By our estimates in the first quarter, Tesla had 30% market share. Yeah.
That's a big number. That's a big leap.
Yeah, now those are all crude and rough, and you know, we're backing into all kinds of numbers. I know that's not the right number, but they have gained enormous share in this, and they're gaining enormous share of total auto sales, because total auto sales went from, let's see, 17 million a year ago to 11.4 in March. And Tesla's sales on a year-over-year basis, now we only have the total first quarter, I think, but I think, again, I'm not exactly right. Their sales didn't drop by 40, 50%. I think they went up by 30, 40% year over year.
Mm-hmm. Yeah, it's pretty incredible. And then I guess this leads to kind of longer term, right? One of the things that we talked about last time when we recorded was the idea of the autonomous taxis, right? And you kind of, much farther out. When I asked for people to questions to send in for you, one of them was around this idea of if that is the ultimate kind of end state here, and that's where a lot of value gets created as well. Does it make sense at any point over the short to medium term for Tesla to create an actual ride sharing app and start competing with the Ubers and Lyfts of the world? Or is it more continue to invest in R&D, continue to build out the actual technology, and then you back into the fleet, at some point in the future?
Well, it's a great question from a couple of angles. First, Tesla's ability to produce is limited by, the constraint is management. And so they need to build out management, and they are. And so in the meantime, as they're revving up on getting their management infrastructure in place around the world, Europe, Asia, and so forth, here, Texas, another one, we do believe that they are going to start their own ride-hailing service. Elon has hinted as such. I think there was a question on, I think it was a recent conference call, but it could have been a podcast, where Elon said, yeah, it sounded like a good idea. Usually when he says that, done, Now, the reason it's also a very good question is I think Uber and Lyft are in a world of hurt here. And the reason for that is the way that business was beginning to evolve is you were getting these entrepreneurs who were saying, okay, I'm going to buy several cars here, and I'll buy the cars, I'll own them, and I'll populate them with riders. Well, guess what? They were on shoestring margins probably in the early days, anyone in the early days. So a lot of them are going to be out of business. They'll lose the cars and all of that, and that's sad. So there is an opportunity here for Tesla to come in, and what that will do, it'll do two things that are very important strategically for Tesla. One, it will increase their free cash flow. It's a very, very profitable business relative to their base business today, which is just producing cars. That's the just producing cars is, a 25 to 30% gross margin business, and this is probably this one, if it were their own ride-hailing service, would be north of 50%. The way they would probably do it, interestingly, would be to say to these former entrepreneurs, if you give us 5,000 down on a car, we will let you become a part of our fleet. And you can pay down that car by giving us a percentage of your fees. The take rate, it would be the take rate. The take rate for Uber and Lyft is 25 to 30%, and we think that's going down. We think Tesla's take rate could be much higher because these owners would be paying down their cars over time, and they'd be employed in this business. So it's a win-win for both sides. It's also a win-win in two ways for Tesla. One, the free cash flow. The second is having a ride-hailing service out there means their collection of data will go into overdrive. They'll be pushing cars out that drive 50, 60% of the day instead of I drive my Tesla 5% of the day. So that I don't collect very many miles per day for Tesla to inform its AI deep learning neural net systems. Whereas these these drivers would be contributing a lot to the data.
Yeah, it's super interesting. Another name that you've been quite bullish on and actually agree with is somewhat underestimated is Square and what they're doing in the FinTech and payment space. Maybe give us kind of your thoughts on just like why so bullish on that company, and then we can talk through some of the intricacies or nuances of it.
Yeah, and I'm going to give a shout out for to Max Friedrich, who's our analyst, and we're just about to publish a white paper on comparing Venmo and Cash App to traditional banks and even to each other. You know, Venmo is a bit older than Cash App, and because of that, Cash App has some advantages, certainly in terms of its agility and in terms of marketing strategies. And you know, it's a younger team, I would have to say. And we got a lot of data, you know, from PayPal's API. You know, they basically publish this data. So it's a very rich white paper in terms of learning about these ecosystems and learning the competitive advantages that both PayPal, Venmo, and Cash App have relative to banks. So in the case of Square, you know, I just love it because it is really enabling, you know, the lower income strata of this economy, anywhere from the lower income to the highest income. But really, it's much more meaningful to the unbanked. And if you look at where Cash App really took off first, if you look at a map and you compare it to an FDIC map of the unbanked and underbanked part of the United States, you'll see the overlay is almost an exact match. Wow. And so that's how it started. And it started with these mom and pop businesses really using the Square point of sale device to put on top of their cell phone to actually do business. And so what can Square see? Unlike a bank, which maybe sees end of month or end of quarter income statements, Square sees every transaction that this merchant has, and can see the cadence, can see when business is good, when it's bad. And what it's starting to do now is say, hey, we see that you're growing your business. We can offer you a working capital loan. And guess what? You can pay that loan off as your business, you know, daily you can pay a bit off, you know, so it becomes a real time. Oh, and we see you probably need more employees. Hey, we can help you with a payroll service. And then they will start infiltrating a consumer base too, which is part of the employee base of this. So it's Cash App gets added strength because it's becoming part of a bigger ecosystem that is proliferating, first through the South. Now it's moving up. We're seeing it move, and you'll see on the maps how it is. So the competitive advantage that these companies have relative to banks, I think, is going to destroy banks. It's going to turn them into commoditized utility. I mean, there will be a reason for banks, but it's not going to be the most profitable reason there are for banks now. The other reason banks are going to have so much trouble, if you look at the number of digital users and include banks in the United States, the banks were doing pretty well until Cash App and Venmo started gaining critical mass. Now, according to our estimates this year, Venmo's already above JP Morgan, which is something like more than 40 million, something like that. And Cash App is not far behind. In fact, we believe Cash App will pass JP Morgan this year as well. Now, how is this happening? The banks have the installed base. That's always the trap when you're talking about innovation. Oh, the old guard says, that's our market. We're going to wipe these newbies off the face of the earth. We can do that. Not so, because the cost of customer acquisition for Cash App and PayPal is a fraction of that of the banks. Banks have to pay to attract a new checking account or a new credit card or debit card, somewhere between, they have to pay from a marketing and other costs, somewhere between $350 to $1,500 per. And the reason they've been willing to go as high as $1,500 is because these customers typically have been very sticky, and their lifetime value has been very lucrative for the banks. Today, Cash App and PayPal pay $20. Think about that, $1,500 versus $20. And the reason for that is because of the viral nature of Cash App and Venmo. You know, if you're telling, in the case of, I mean, it's kind of funny, if you take a look at how quickly social networks evolve, so the Facebooks and Googles of the world, if you look at Cash App and Venmo, their uptake is twice as fast as social networking. They're much more viral. Why is that? Well, for the social networks, Facebook, Instagram today, you know, young people don't really want their parents to be following them, right? But when it comes to Venmo and Cash App, heck yeah. Come on, mom, come on, dad. And so their parents are being forced into this faster too. And if you look at the various cohorts, cohort by cohort, both the younger groups and the older groups are moving on to Cash App and Venmo twice as fast as they moved on to social media. So this is becoming a big business. And so I often say banks had these creatures, the Venmo and Cash App, nipping at their heels, right? And we can't even say creatures and nipping. They are, you know, they are overtaking them in the digital realm completely. But if you even think on the deposit side, I know this crisis will change this to some extent short term, but I don't think it will change it long term. You've got Marcus, Goldman Sachs's Marcus, which, you know, they are really trying to become, they're trying to move into the digital realm and take advantage of some of the low cost of customer acquisition like Square and Cash App. You know, they have been competing with the banks who were offering maybe 50 basis points for deposit accounts. For a while they were over 3%. They're not now, but in order to make inroads, they're going to have to go for the jugular of the banks. And the jugular is that net interest margin, which is the difference between what a bank gets on a loan and what a bank has to pay on deposit accounts, which fund these loans. So it used to be huge before Marcus came around. And now Marcus and other newbies, I know SoFi and others are offering, even today, crazy rates relative to what's offered in the markets. And they're probably taking risk to do that too.
Yeah, and I think in one of the recent reports you guys put out, I think it was the Big Ideas presentation for 2020, one of the things I saw that was really interesting was the market is valuing the users differently as well, right? So the idea that the bank customers are getting valued at a premium to the Cash App or Venmo users, and ultimately you expect that it at least comes to on par, if not at some point the Cash App users and Venmo users are more valued. So maybe talk a little bit about that.
Absolutely. Very good. You really dug into Big Ideas. Not many people dig that deeply into it.
I read it every year. It's great.
Yeah, thank you. Thank you. Yeah. So if you look at what investors, I think it's a bit different now after the crisis, but when we did Big Ideas at the end of last year, investors were willing to pay $3,600 roughly, depended on the bank, $3,000 to $3,600 for each deposit holder or deposit account. If you look at each user in Cash App and Venmo, they're paying anywhere from $50 to $150. We think, so that would mean that the market, the public equity markets are paying 20 times plus for banks, when these guys are about to eat the bank's lunch, right? And so it makes no sense. And they're much more valuable models also because of the virality. They should be valued more like social networks than banks. And yet they're completely dismissed out there. And I think it's just because people haven't done the homework. They don't really believe this yet. You can't say these companies are too small anymore. They're growing, and they're growing very rapidly. But I think it'll only be time, and we'll catch up. So that's why Square is in our top 5 in both our flagship and our FinTech funds, and actually our next generation internet fund.
Yeah, it's really interesting. I've told a story before to others, but I've got a brother who is, I think 23, 24 years old. And one day I asked him, kind of joking, giving him a hard time. I said, do you know how to send a bank wire? Right. And as you would expect, his response is, what's a bank wire? And I said, well, how do you send money to your friends? And I expected a Venmo or a Cash App type. And he said, well, 2 ways. He said, Venmo is one. And then he said, Uber. And I remember thinking to myself, Uber? And he said, well, yeah, like when I get out of the car, we split a ride, basically like Uber does it for me.
Yes.
And I was like, that really just highlights the difference of how, his generation of kind of young 20s, they literally think of Uber as a way to pay their friends. And I think that most people over the age of, 35, they've got no clue that that's even a possibility, let alone that that's how a kid would think about it.
Absolutely. If Uber's underlying business weren't so bad, we'd probably be more interested in it for that reason, honestly. I'll just make one more, or give you one more thought, very relevant to your world. Cash App has been so creative in marketing. And I think, the Cash App Fridays where they give away 1 Bitcoin, and you can buy and sell Bitcoin in the Cash App. It's pretty seamless. I believe, and I believe this is one reason Jack Dorsey was going to move to Africa for a while. I believe that this is Square's way of infiltrating the emerging markets. Now, they have an extraordinary opportunity now, because what we say about innovation when it comes to emerging markets is even more true. They have to usually run away from disaster in terms of the loss of purchasing power associated with their currencies. And Africa gets hit every time. And so to bring Bitcoin into that realm in a way that they're able to, I'm sure capital controls and regulation will present some obstacles, but to the extent they can help salvage the purchasing power and wealth of some of these individuals. Bitcoin, with all its volatility, was up big last year. It's up year over year still, I believe. And their currencies have been smashed, right? And so I think that Square's way of infiltrating the emerging markets has been very difficult. There are a lot of obstacles that the developed world puts up as Square tries to migrate into Japan and then to Australia. It takes a long time. I think it could happen a lot faster in the emerging markets. And the same is, of course, true with PayPal.
Yeah. I can't let you go without talking a little bit of Bitcoin. You are obviously one of the most bullish people, I think, on Wall Street. Maybe let's start with just what you guys have done with your Bitcoin allocation over the last month or two, and then we'll get into some of the other aspects of it.
Okay, so I can talk about this in 2 ways. Only one of our ETFs is holding Bitcoin, GBTC, Grayscale Bitcoin Investment Trust. And there are new instruments. One's just launching in Canada. So we're analyzing, we're doing the compare and contrast there. So we may change things up a little bit in terms of the exact instrument. But we have added to it it's our next generation internet, ARKW. We've added to it. We cannot go, and this is a limit we've imposed on ourselves. We cannot buy above 2%, and we're closing in on that now. And the reason for that is if we do, we risk subjecting our shareholders to something called unqualified income. And I think I mentioned it to you on our last podcast together. Unqualified income, if more, it's not illegal, but if more than 10% of a fund's returns, of the gross profits, is in unqualified income, and in this case, just think of it would be like commodity-based income. It's not financial markets, it's more CFTC regulated. So if more than 10% of our gross profits is in unqualified income, then the IRS, and these are realized profits, the IRS would be able to confiscate everything above 10%. Now, what's the nightmare scenario here? Say we're in a black swan event and the fund drops by, let's say it drops by 50%, which was 0809, right? That was, some funds dropped 50%. And let's say Bitcoin went up and it hit 10% of our portfolio. Say it went up 100%, hit 10% of our portfolio. It would be generating all of the profits and we could only keep 10% of them. Mm-hmm. In other words, and it's even worse because we'd be generating all these losses, and of the gross profits, this is not net, this is gross profits that Bitcoin would deliver. Let's say it was up, say it went up tenfold, we'd only get to keep 10% of that, and we'd be realizing the loss on the rest of the portfolio. So it's a little bit crazy, the rules and regs, and hopefully they change over time. In our discretionary portfolios, which are not 40 Act funds and where we can do what we want, Bitcoin is about 5% of the portfolio. And we bought during the swoon, the swoon from, it was from very quickly from 8,000 into the threes. And we're happy there, 5%. I think that's good for especially given what's happened to the rest of the stocks. We had a big correction there as well. So we've been doing a lot of trading.
Yeah. And let's start with the kind of Black Thursday, if you want to call it, or whatever, somebody's going to come up with some cute name for it. But there was a drop of 50% in the Bitcoin price. A lot of people, I think that even the strong hand holders, while they still held, I definitely got some phone calls. Some people were like, oh shit, this doesn't feel great. Maybe, kind of what was your analysis on like what happened there and kind of how you guys thought about that?
Yeah, I think the shock for a lot of people is that we've been able to say for so long that Bitcoin is uncorrelated. And here we were in the middle of a difficult market for equities, and we were facing difficulties with this one as well. And many people who are in both worlds were just probably a little shaken up by that. That was not supposed to happen. We didn't think it would happen. And so this notion that all assets correlate to one in terms of their performance, now we can say applies to Bitcoin in a crisis. It makes a lot of sense. A lot of the people involved in Bitcoin run hedge funds. We are primarily a long-only equity manager. So it makes sense when one market is hurting, the others will as well, as there are margin calls. Now, what I didn't know as that was happening, Yassine Al-Mandra, who I believe you know Yassine.
I do.
Yeah. He, at our brainstorm that week, went through the 100 times leverage on this, that, and the other exchange. And I remember saying to Yassine, I said, Yassine, I know a lot about Bitcoin. And I also am on the lookout, especially during difficult markets, for leverage points. Who has the leverage? Who's going to be forced to sell? Where the margin call is going to be? And I said, but I didn't know there was 100 times leverage out there anywhere. and I said, is this common knowledge? And he said, it is in the Bitcoin world, but I think the disconnect, if I had to be honest about it, is those in the Bitcoin world, that became normal because these guys they could do no wrong. They could do no wrong, so And by the way, in the equities market over the years, I've always learned whenever I think I can do no wrong, watch out. Just watch out. Start taking the risk off, right? Because it's too easy. That's what happened. And there were too many out there who were leveraged to that extent, who had no idea what a bear market would do to them, like kill them. They're dead. Now, I think the good thing that's happened about that is everyone knows leverage is something you really have to watch. And, even in terms of, our future plans, we, in terms of using leverage in the crypto world, I know what to do. I've run hedge funds and so forth, but it's very clear to me that the people who were stuck, I don't think they were the sophisticated hedge funds. They were the individuals who got hooked and then, began to believe they could do nothing wrong, and then now are out of business. I think it's a good thing for the ecosystem that that understanding is look for the leverage. That's where your weak link is. And you can even say that in the various crypto asset ecosystems. They all learned a little bit more. The governance on some of these is excellent, but they all learned a little bit more about how to adjust their governance to look out for that as a pain point, as a potential pain point and risk factor, which I think is good. I think it's good for the whole ecosystem.
Yeah, it's one of those things where people got to learn the lesson, right? And then I think that definitely happened. And the other piece too is a lot of the people that were selling, getting liquidated, et cetera, they're not the long-term holders, right?
Yeah.
If you look at most of the Bitcoin that moved that day and kind of the weeks before and after, it's all things that have moved in the last year. Right. Yeah. Pretty much there's a bunch of people who hold on to it and they believe it's going to be a very binary outcome. There's no leverage. There's no anything. There's passive holders. And that number continues to grow. So I think generally headed in the right direction.
And it's great. It's great that there's data on that, because I know Yassine has presented us with that chart. Who sold? All recent buyers, pretty much. Very, very little by the long-term holders.
Absolutely. And I guess last question for you on Bitcoin before we wrap up is the halving is coming up. And one of the concepts that I've spent a lot of time on recently, and I wish that I remembered who came up with this terminology, but they said, look, if you anchor on in the legacy world, we're having quantitative easing, right? Kind of the expansion of the balance sheets and this liquidity injected. We're about to get quantitative hardening in the Bitcoin world. And so maybe just some thoughts on how that halving should play out given the macro backdrop and kind of how you guys are thinking through that.
Yeah, we had a big discussion about this at our brainstorm last Friday, and you would be very welcome. Actually, your listeners are welcome in. You can, we do have Life Size, which is the system. I'm not sure how many we can handle, but we are getting quite a few people tuning in now. And the concept was around, and what I loved about Yassine's kind of presenting both sides, he said, I'm kind of, I don't know, I'm not sure which side I fall out on here. I have a very simple approach, and Brett Winton, our director of research as well, weighed in, and we went back and forth on it. And I think just in a very simple way, from given the backdrop, the economic backdrop that we have, when this halving, and I don't know if you call it halving or halvening, but when it takes place, and the rate of inflation is cut in half, there are two things that will have happened. One, another very important software update in the ecosystem, right, without forks and just at least that I know about. And two, no intervention, despite what's going on in the rest of the world, where everyone's intervening to throw everything they can at a problem, no intervention. That 21 million is, so that will be another proof of concept that this is going to happen no matter what is going on in the rest of the world. I mean, if there were developers so inclined, they could have said, look, we can't do this in the face of what's going on. No, you must do it in the face of what's going on out there. This is the proof of concept. So from my point of view, it'll be a very positive event. Now, I was in the camp for a while as people were talking about the halving and saying, okay, this is going to be a very bullish case, and the price was lifting, and we got into the 12,000 or wherever we got then. I was thinking, okay, this is it's taking place now. Typically, you discount these things ahead of time, but with this, this eruption in the market, in the Bitcoin space as well, I think on balance is going to be a positive event. And, it's the end of May, is it?
May 11th to 13th, somewhere in there. Okay,
mid-May. I think it should be a positive event. I don't know why it wouldn't be. I can't imagine a reason it wouldn't be unless the software, unless something goes wrong with the underlying technology, which I highly doubt.
Yeah, part of what I think I'm personally looking at is you get all of the QE, not just here in the U.S., but also Japan, $1 trillion, kind of a bunch of liquidity just being injected in the global financial system. Over time, people, just like we saw in 2008, 2009, assets sold off in 2008 in that kind of liquidity trap. And then eventually people went for the inflation hedges, right? And through 2009, 10, and 11, gold, obviously, which had sold off 30% in 2008, ended up doing very nicely, hit a new all-time high. And if that happens again, right, which structurally and kind of sequentially is likely to happen, I think, to some degree. If it does, it's going to coincide right around the same time that you get that halving. Right. Yeah. And so it's, to some degree, would be like everyone looking for gold and half the gold miners in the world shutting off at the same time. Yeah. Right. And seems bullish. But again, we kind of have to watch this play out and see, does the halving actually occur? Does the code execute, and kind of does the macro backdrop execute as well? And we'll see.
Having met some of the key or the core developers, I had the privilege of meeting a number of them last year, and I was so impressed. I would be shocked if something went wrong with the software, and the resolve to hew to the 21 minutes, the cadence, all of that. I was, as I said, my confidence in Bitcoin went up dramatically after I met them, because before that I kind of thought, these are kids who have never seen any crisis and blah, blah. That's not true. I was able to have a solid economic discussion with a number of them. I mean, deep economic theory in a way that I never imagined. And that's because there are gray hairs there are young, but then there are gray hairs, people very committed to this. So I was struck by that. And my conviction in Bitcoin went up enormously after that. So, and I will say it's gone up. I was a little like this 100 times leverage. What the heck? And seeing Bitcoin disconnect from gold itself, I was saying, okay, there's something wrong here. And that's when we had the brainstorm session. I mean, Yassine had mentioned it, but the brainstorm session was about leverage and then the halving. And, what would the net be? So I think where we come out on this.
Absolutely. Well, listen, Cathie, I really appreciate taking the time to do this. People are really, really excited to kind of hear your thoughts on a whole bunch of this stuff. You guys have done a fantastic job, I think, not only kind of presenting all of the information and research, which people find valuable, but obviously two, as I like to say, the scoreboard, kind of proves it for itself. You guys have done a great job there as well. So just for everyone else, thank you for doing this stuff. Where can people go find either information, or where would you like to send them if they want to learn more about ARK and kind of your process and reports?
Yeah, so ARK- invest.com is our research site.
Awesome. Yeah. All right. Well, we will definitely have to do this again. Yeah. I think that people love to hear from you whenever you want to do it. So thanks so much.
Thank you. Thank you very much. It's a fantastic forum because you know what? You really like to dive deeply into what we're doing. And that's the only way you can understand how profound some of the innovation platforms we're researching are. I mean, they're going to deliver exponential growth for years. And you are really doing your viewer base an incredible service.
Well, I'll leave you with one thought, which was I saw somebody tweeting saying, tell Cathie to go on CNBC more. She can't let Chamath have all the fun. So if people will love the hot takes there as well, if you want to go do them.
Okay. Well, thank you. Thank you. I much prefer this forum. Thank you. Take care.